Cool. So what we're going to go over right now is basically just how hard money works. We're not going to go through the Burr method, right, because we're going to cover that in another session about refinancing. Just a real quick breakdown of how hard money works, right? So what is hard money? Hard money is a bridge between your first purchase, so your purchase on the distressed property, and you're bridging that out to either flipping the property, so reselling it on the MLS, or you're going to do it as in a refinance, right? So you'll actually see on some loans now, they'll call it a bridge loan because you're bridging from the first loan to the second loan or to the resale. So why did hard money start? Hard money started because of your traditional lender, your Wells Fargo, your Chase is not going to go and lend on a property that has all 5 majors, right? Or even 1 or 2 majors. So if the foundation's bad, the roof is bad, the electrical, the plumbing, the HVAC is bad, well, the bank is going to come in and say, well, you know, we don't want to lend our money on that because if we had to take it back and resell it, it's obviously worth a lot less, right? So hard money started really to be able to purchase those properties so that you can long-term get that conventional lending, right? Or your end buyer will get that conventional lending. So the 2 most important elements, if you were going out there exploring a hard money loan, and they're going to give you 2 figures, right? They're going to give you the points, and they're going to give you the interest. So these are really the 2 numbers that they're going to give you for any hard money lender to know kind of what their terms are. So you'll hear it a lot in real estate. You'll hear we do 2 and 10, right? Or 4 and 14, or 3 and 10. Okay. So what they're referring to, the 3 of that would be points, right? And then the 10 would be the interest. So how do they calculate this? They calculate this on the total amount that's borrowed, right? So let's give an example of a property that we would sell here. Let's say, David, let's do that 160,000 one you're working on, right?
Mm-hmm.
What's your repair? 50,000. Okay, if we sold this at 78%, what would be our loan amount? Right. So 160,000 times 0.78 minus 50,000. Yep.
74,800.
74,800. Someone want to verify that? Charles? So 74,800 is basically what you're asking to borrow from your hard money lender, right? Or this is the amount that it's sold for, right? So if you were to get the 74,800, you don't want to have to come out of pocket $50,000, right? So you need to basically calculate how much money I can borrow, right? And you're paying for the right to borrow that money short term. So generally, a hard money loan is going to be maximum up to 6 months without having to pay any penalties. Okay. So how is the hard money lender protected in this scenario? Because a bank doesn't want to lend on the beat up property, right? But the hard money lender will. Why will he lend on that property? It's because it's asset-based lending. He's basically banking on the fact that this is a pretty sound investment for me because I'm buying this property at a discount. Worst came to worst, you're new in this and you didn't do the rehab correctly, your contractor walked off, you don't have enough money to finish it, they would foreclose on you, right? So if they foreclosed on you, they would still need to sell it and break even, make a little loss, or make their money back. Essentially what they're doing, right? So your points and your interest, and then another figure that they're going to give you is their LTV, right? So this is a very important term. LTV equals loan to value, right? So when you go to your hard money lender, they're going to make you get an appraisal. So when you have your appraisal, they're going to come back and hopefully it's going to be at the number that you gave them for the ARV, right? Mm-hmm. So if the appraisal comes back at 160,000, well, let's say that this hard money lender, like ours does, Searchers, right? They're going to do 75% of this value, right? So what, Charles, is 75% of 160,000? Or anybody here?
120.
120,000? Okay. So 75% of 160, your hard money lender is agreed to lend you $120,000 for your project, and the terms of the loan are, or what you're paying to borrow that money, is 3 points and 10% interest. So how do you calculate your points? Points is just a very fancy name for interest, or for interest on the loan. So if you have 3 points here, it's going to be 3% of your loan. All right. So here's how we figure our points. 3% or 3 points of 120 is what?
3,600.
3,600. Okay, so that's your points. You're also going to have something called a doc fee, which most hard money lenders won't tell you. That's generally about $700 to $800. It's called a doc fee. Right. So the interest on the loan is an annualized interest, right? And you're paying the interest monthly as you go along. So every month you're paying that percentage on that. So what is 10% on 120,000 annual? It's 1,000. Yeah. So every month you're basically going to be setting up like an auto payment or auto draft to your hard money lender until it's sold to take out $1,000 a month from your account, right? So a month goes 1,000. So you can kind of see why it's important to get your project done quickly, right? You want to get the hard money gone. You want to sell it or you want to refinance it. Okay. So to borrow this 120,000 at the closing table, I brought my 3%, which goes straight to the lender, and I brought my doc fee, which is going to go straight to the lender, right?
Mm-hmm.
So what happens? Your purchase price on this property, remember we sold it for $74,800, but you're borrowing 120. So do you think the lender is just going to say, well, here you go, here's $120,000, pay it off, right? No, what they're going to do is they are going to hold your repair bid in escrow. Okay, and we're going to go on the searcher's website, and we're going to show you how you would go and make a draw request on there. So this, what's the repair? 50,000. So the 50,000 would actually be held with searchers, right? It would be held in escrow. So otherwise, what happens? They give the money out. You pay you pay your contractor the whole amount of money, and the contractor says, "Well, great, I've got paid already. Why am I going to do the work? I'm just going to walk off and leave." So what happens when you have a contractor is you make them familiar with the hard money lending, and they work to a draw schedule, right? So maybe it's 5,000 a week, 10,000 a week. It's going to depend on the lifetime of the project. Okay. So your hard money lender, like what Kellen does here, is when he goes out of the office, a lot of times he's going to do a draw request. Okay, and a draw request is you've done the foundation, or you've done the roof, or you've done the windows, and he's going to verify out there that you've done the work, right? Mm-hmm. So basically assure that the money that they're lending you is being used to fix the property effectively, right? That just keeps everybody protected. So what happens when he does the draw? Let's say 50,000 was done in draws of 5,000, right? So that's 10 draws over the lifetime. So 10 draws. Now what happens if you're doing a draw of 5,000, every draw that you do is $150, right? They got to pay their bank fees. They got to pay whoever's going out there to inspect the property. So they give you a $5,000 draw, but then they're going to reduce it by $150, right? So just account for, if you did 10 draws, it's going to cost you $1,500, right? Right. So, does that all make sense? Any questions on that? So your purchase price, so what you're bringing to the table, to the closing table, is you are bringing the $3,600, you're bringing your doc fee, and then what are some other fees you think you're bringing that are outside of the hard money lender?
Closing costs?
Closing costs, right? Standard closing costs, escrow fee, right? If you're on the HUD, if you're paying the closing cost, right, instead of the seller, then you're going to be paying the title policy. Right.
Would your earnest money count?
Sorry?
Would your earnest money be
earnest money?
Yeah, well, your earnest money is going to be credited towards the purchase price. But yeah, you would have already given them your earnest money.
Okay.
So that would be out of pocket, so to speak. So what's happening here now is the HUD is basically going to break all this down, right? So you have a $120,000 loan, right? And then out of this $120,000 loan, you're going to have these costs. So you're going to have purchase price to your wholesaler or your homeowner, $74,800. That's your purchase price, right? Your $50,000 is going to be on the HUD, but that's going to go into escrow, right? And then you're going to have your doc fee on there, and you're going to have your points. Questions on this? We're going to actually go down this HUD and kind of break down the repair, the construction holdback, and how it works on the HUD. Right, so it's just important to be able to, when you're buying your own investment properties, to understand how to break down the HUD. Your HUD on a cash transaction is going to be very simplistic, right? You're going to have your purchase price, your cost, and then what you're bringing to the table. So you're also going to have it when you're buying a house and maybe your realtor or your homeowner sees that there's more money on the HUD, because you want to be able to explain a hard money loan breakdown on the closing disclosure, the closing statement. So this is a very common settlement statement. It's what we call a HUD. They've kind of changed the name to closing disclosure. So let's kind of go through this. You're looking at what type of loan is it. On here we don't have it marked, but if it's a cash sale, if it's FHA conventional, it's going to be marked here. You're looking at your borrower. So KMN Realty is the borrower on this HUD. So they're the ones who are getting the hard money loan. And this is who they're buying it from, William Redding. This is where the lender goes. So this is where you will see Searchers Capital or whatever hard money lender they're using. This hard money lender is called Lending Home. They're a very big hard money lender. I think they lend nationwide. So let's kind of look through it and find out what terms this borrower has on this deal, on this property. The property is Grapevine Street, 401 Grapevine. So this was a burn house, by the way. So let's see how big that repair is. Can anyone tell me from here where they see the repair?
52.
Correct, 52,200. So it's pretty light rehab for a burn house, but she borrowed 52,200 in escrow to fix this property on Grapevine Street, right? So her contract sales price, what we sold it to her, was for $40,000, right? This is a double close. We had already owned the property. We resold it to her. So you're not going to see an assignment fee on this HUD. So this line here, the settlement charges to the borrower, that's just a total settlement charge. So as we go down on the borrower side of the transaction, we're going to see their the costs that add up to the $16,531. So this, go back up, this is the borrower's transaction on the left side. Everything on this side is going to relate to the borrower. Everything on this side would relate to the seller. We don't have the seller fees on this one, but this is what would relate to that. So this is the gross amount. If you go down, this is the gross amount due from the borrower is $108,731, and this is what she brought to the table. $14,731. So to closing, she would have to bring her cashier's check for that amount or her wire for that amount to own the property. And the total for the purchase is $108,731. So if we go up, you're just working down these costs. So she had $1,000 as earnest money that's going to be credited toward the purchase price. And the hard money lender, how much money do you think they lent on this property total? The principal amount of new loan, right? So this is a new loan against this property. It's for $93,000. So when she goes to resell this property, that's pretty much, that's what she's gonna have to pay, $93,000 to clear that off, minus any other little closing costs she has when she resells the property. So Lending Home, if you pull up the deed records, they're gonna have a deed of trust against this property for $93,000. So let's work out the loan origination fee. Items payable in connection with the loan. You're going to see this on the HUD. This is everything that they are bringing to borrow that money, what we just covered. So loan origination fee percentage is $1,200.
1.29 or 1.3?
Really? That low? Okay. So they got a pretty good low points on here. Do we have our interest rate on here? You're going to have to back calculate your interest rate on here. This is prepaid interest, and they pay that in advance, right? And then look at our service fee. So basically $1,000, right? $999. That is what we're talking about when we talk about the doc fee. That's a service fee to process all the paperwork and everything filed. You know, pay for the staff in the office, so to speak. Here you're also going to see the insurance has been wrapped into the loan. So what is another thing that the hard money lender is going to require? They're going to want to make sure that the property is insured. So when they look at the closing statement and sign off and agree to get the money, they're going to make sure that your insurance is already binded, right? It's already been sent over and it's in effect. So the escrow officer is responsible for paying the insurance company so that your insurance is effective here. And you can wrap that into the loan.
So that is the price, you know, like insurance you pay every monthly. Is it for all the, like she pay, on top of that she pay
Yeah, you're
every
not gonna,
month
you
after that?
can't pay the insurance month to month on these loans. You're gonna have to pay for the 6 months up front. If you went and sold the property early, then you can always contact the insurance company and they'll give you a rebate to that insurance, right? It might not be the full amount, but they'll cut you back a little bit. If you sold this house in 2 months, but your hard money lender was requiring you to get 6 months insurance, well, you're gonna get some kind of rebate back from the insurance company, right? But why would they not do it monthly? Because they would have to track that you're actually paying that. If the property's going wrong, right, and you're running out of money, you're probably going to stop paying the insurance, and then the house burns down, then nobody's insured for the property. So when you get your insurance for the hard money lender, what happens is they have to be listed as what you call the loss payee. So on this one, it'll be the insurance company. If the house burns down, who gets paid? The lender gets paid, right? Because they want to make sure that they recoup their $93,000 on here. So. If you keep going down, so this way, so see if you guys can tell me what you think these are, right? So notary fee, do you think that they signed, where do you think they signed the paperwork to get it closed? Well, there's a notary fee on there. So do you think the title company would charge them a notary fee, or do you think maybe they had a notary go out to sign for them?
Go out to sign for them.
Yeah. So a mobile notary, that's where you're going to see that. That means maybe because of COVID, they couldn't go to the office, so they sent them the notary to their house or to their place of work or wherever they chose to get that signed. So the buyer is paying for the notary. So on the HUD, where do you think the title insurance was marked? Do you think it was marked as buyer or seller? Look at line 108.
Buyer?
Yep. Right? Because we don't even have our seller cost on here. We're looking at just the buyer cost. So the title insurance was paid for by the buyer. So on the HUD, you would have seen buyer pays for closing costs, right, when we sold the property. Escrow fee. That is, they are actually paying for both sides of escrow fee on this one, but as you can see, this is what they have to bring for the escrow fee. It's $700 to that. Okay. These are, little miscellaneous fees you're always going to see on title companies, little kind of dead fees, tax deletion endorsement, not yet due and payable, environment protection lien, PUD endorsement, tax certificates, recording fee, right? All these deeds, everything have to be recorded with the county, so the title company pays that, and then you're reimbursing the title company to do that for you on your behalf. So actually, no, this was not a double close, right? This was a joint venture. Okay. Yep. So if you look at earnest money credit, Rightway Home Solutions, we put down $1,000 for the property, and then this was a $10,000 fee, and then we split the assignment fee with Rightway and James Ferris. So what are we getting back here? We're getting back $5,000, which would be our net profit, and then we're just recouping the $1,000 we put down as our earnest money. Or getting that back because that's outside the transaction. That was our money already. So we made $5,000 on this property. Okay, but the buyer has to pay for our assignment fee, right? This is coming out of what they're bringing to the table. So they're bringing $14,000 to the table. So, and this is your total settlement charges here. This is what it costs to close the property, $16,000. But again, if you go back up, this is the most important numbers you're looking for. is your cash from borrower, and then this would be cash to seller if it was shown. But since we're talking specifically about hard money, you're trying to work out the terms of your loan or what kind of loan they're going on. If you always go to the second page, this is, always just keep an eye out here of the terms. You can kind of work those terms back to see how much they're paying on their hard money, right? With your loan origination fee, your service fee, and then your interest is going to tell you, this is a daily interest, right? So they're paying $16.25 per day
Wow.
for their hard money loan, right? And this is just prepaid interest. So let's go, sorry. Let's go into the Searchers Capital website. This just kind of shows you how you would do a draw if you're doing it. Right. So if you are not technically advanced, you can always download a PDF version of the draw request and you can just fill that out. You can send that to Kellen. Right. But we're going to do this one online. So obviously your first and last name. This is the draw property address. So you're not putting in your address here. You're putting in, if that was your property on Grapevine, you'd be putting on Grapevine here. Okay. Street address, city, all that. Borrower information. This is your email address, number, your actual home, street address that the hard money lender is going to have on file. Your loan originator name. So if you click on this is everybody related to Searchers Capital. So this is whoever helped you generate the loan and who's going to go do the draw request. Right. So here in Houston, obviously, we are Kellen. Jose Romero is San Antonio. Kurt is in Dallas, Fort Worth. Right.
Gabe.
Gabe, I believe, might be in Atlanta.
Dang, it's Kellen?
I'm not sure.
That's over Houston,
So access to property. This is basically to tell Kellen, I'm going to go look at your work, make sure that it actually got done. You're going to put, access to property. Is it by appointment? Is it by lockbox? So he can go out and check it. And then what day do you want him to go inspect it? You're going to put that there. Funding information. This is basically, it's going to go straight into your bank, right? If I've requested $5,000 draw, here's my banking information. It's going to get wired to me. And that's generally going to be wired as soon as they make the inspection or the next day, right? The hard money lender companies know it is imperative that you are keeping your contractors flowing, right? So if they took a week to send the draw and you haven't paid your contractors, they're not going to continue the work. So they know that time is of the essence in this type of project. So same day or next day, they're going to give it to you as long as all your information is filled out correctly. So your bank name, account number, all that, street address on your bank. If you keep going down. Now this is where your list of repairs is gonna match to your contractor bid that you sent in when you requested the loan. So if I did the foundation for $5,000, then rehab budget estimated amount, I put $5,000 on my rehab, and then how much am I actually requesting? I'm requesting $5,000, right? If you're doing a bigger project, you might do less draws. You want to do less draws if you can, right? Why? Because it costs you $150 every time to do a draw. So if you can get away with paying your contractor up front, or not up front, but that portion, and then request a bunch of those repair items in one draw, it might be a little bit more on your bottom line. So if we go down, you put all your repairs in, how much you've requested here. It's going to give you a total draw request amount, and that's going to go over to your guy. It's going to go over to Kellen. He's going to say you've requested $5,000. He's going to go to the property, check it, push the green button, and that wire is going to go into your account. Right? You're also going to need to put your insurance information. So this is basically who you have it insured with, who your person is there. So, and your certificate of insurance. So you have any questions on that?
How do the hard money lenders get the repair money back?
Well, when you sell it, right? So that's a good question. Your total loan on the property is $120,000. So where is that filed? It's filed as a mortgage, as a lien, right? So your deed of trust, right? You have two separate things. You have a deed and you have a deed of trust. The deed of trust basically means there's a loan on the property, right? So your loan is 120. So when you go to resell the property, right? Let's say it's worth 160. When I've sold this property on the market, for example, or I refinance, I have to pay this $120,000, you know, on my new closing statement. So that's how they get their repair back, because they've given you your $74,000 for the purchase, and then they've held that back, and they've given that to you over the lifetime of the loan. But as long as they get their $120,000 back, they've done great, right? They've got their money back, they're good to go. So in this scenario, how much did the hard money lender make within the 3 or 4 months of the loan?
3,000.
No more than the 7.
Well, here they've made $3,600 in the points.
Plus 1,000 of the
They've made
loans.
$850 in the dock fee. They've made $1,500
Yeah.
in the draws, and then let's say this took you 4 months to get it sold, right?
4,000.
They've made $4,000 in interest, right? So they've made, you want to calculate?
Yeah.
Say
$9,950.
$9,950
In 4 months.
in 4 months.
We're in the wrong business, guys. Now.
Wow.
No, I mean, but they're making $9,000 to risk their money, right? So they've given you $120,000, you know, and it's a pretty fair trade-off, because how much money are you bringing to the table? You know, we'll kind of go over
We're
it.
bringing
but
3,600.
No, you're bringing more than that, because this is
Yeah.
just your points. You have your dock fee, you have your closing costs.
Oh, yeah,
Right. You're
yeah.
gonna have some prepaid taxes. You're gonna have,
Jeez.
escrow, title policy. So, depending on the relationship you have with your hard lender, you can be as little as 3,000 to 5,000, or you can be from 10 to 20,000. Right. It just depends how you buy the property. It depends what they lend for. If you overpaid for the property, they're only lending to the 75%, or some hard money is within 70% of the appraised value of that property. So that's why it's important to get the numbers correct, right? So if I've told this investor your ARV is 160, right, and you're buying at 78% at 74,000, and your repair is 50. Well, if you don't get your numbers right, what happens? The investor ultimately has to bring more out of pocket to the deal. A much sweeter deal, they're going to bring almost nothing, right? You hear the no money down, because they're getting this. Whatever happens, they're getting this 75% loan to value. But what happens when my repair is really 60,000? Well, I got to bring more money to the table. What happens if this appraisal comes back at 150? More money to the table. You understand? Because
So-
you're only getting that. You're only getting that 75%.
I mean, remember when we did the conduit, you said the hard money lender don't let you, they don't give you extras, right? If it's 75%. So
Correct.
they break it even, right?
Yeah. So that's if to bring money. Yeah. So the reason that they do this, right, is because they want skin in the game, right? If you have zero money in the deal on the table, there's a much higher risk that you're going to walk away from that deal, right? You're like, well, I'm not out. You know, he can just foreclose on me, but I'm not out anything. But if you have $5, $10, $15, $20,000 invested into that deal, it's a lot more likely you're going to do whatever you can to make it work out, so you don't just lose that money. So that's the skin in the game.
Yeah.
Yeah.
Another part, you said searchers give us 100%.
Of the
Right.
purchase price in the rehab. That's when you're bringing your
And
cost
what
down.
for us, it's the interest.
Well, you're just bringing less out of pocket.
No, for us, what interest?
10% and 2 points.
Okay.
Yeah. Very standard is like 12, 13% interest and 3 points. A hard money lender, a lot of it's going to do on your experience. So if this is your first flip, right, they're probably going to give you 70% LTV, 4 points, 14%, right, because they want to cover their backs, because you don't really have the proof to show that you know what you're doing. Right, and all of this is protected through the numbers. So why do you have to pay for a survey? Right, a survey is going to cost you $400 or $500, right? But you have to pay that and give that to the hard money company, right? Hard money lender, because they want to see, right? I'm protected at 70-75%. And what's the other thing do you think they're going to need?
Do appraisal?
Well, they got the appraisal. Some of them do require a survey, not all of them. But you got your appraisal. But what's another thing you're going to have to supply them? You're going to have to supply them the rehab bid from a contractor, right? And they're probably going to do, if you're new, they're probably going to do some due diligence on that contractor. Because what makes a bad deal is when the contractor's bad. So that's how they're protected. I have those two numbers. I have what's the house worth and how much is it gonna take to put back together. And that's how they protect themselves. Right? They don't wanna have to foreclose on you, but if you're not paying $1,000 a month, you better believe they're gonna come and they're gonna, you know, exercise their right because they have a deed of trust, they have a lien on that property to say, you know, this is my promise to you that I'm paying you 10% interest on this loan over 6 months.
When you refinance, do you pay anything like for service refinance?
Service as in new closing costs?
No, I'm saying like, you know, maybe when you refinance, you pay like $5,000 or $1,000 for like for the job people refinance for you.
Yes, if you're refinancing a property, you're gonna have costs associated with it.
Okay.
Yeah.
How much is it?
It's almost like a traditional closing. So you're still gonna have to pay.
2,000?
Yeah, and on a lot of the refinance, you're gonna have to go and you're gonna get another appraisal too, right? They wanna verify what the property is worth. They're not gonna bank on the fact that your hard money appraisal, so. But how do you circumvent all that? How do you keep your total investment low? It's if you buy correctly, right? This all depends on how much you pay for the property. If you're buying at a much less LTV, you have so much more money to play with, because if he's still lending on 75% of 160, but you bought this property for 60,000, right? Well, the loan, you know, covers much more of that, so you're not so tight. So that's why you make your money when you buy, they say, right? So if you bought the property correctly at the right price, you put the right rehab on there, your out-of-pocket can be next to nothing, right? And then when you do the refi, you're doing a cash-out refi, if you can, right? So you're cashing out some of that money, and that money would cover those closing costs. So that's why it's important. That's why it's a numbers game to get all those numbers correctly.